Talking about Sundaram Finance now and the top management, the managing director, Mr. Rajiv Lochan, now joining us live right here on the channel. Good morning. Thank you so much for being live with us today. You're one of the best people to also get a sense of what's happening on ground. And I'll begin my conversation with commercial vehicles, which, like commercial real estate, is also considered sometimes to be an indicator of how the economy is doing. Yesterday, we did have Volvo Eicher on the channel talking about the robust demand. But you tell us, as far as the financing goes, on ground, what kind of demand is actually being seen? And with inflation coming in, cost of funds that will go up, do you think the demand will stay as sustainable?
The commercial vehicle demand we are seeing has actually picked up quite nicely. I think after the second wave, there was a further delay in the sort of demand pickup because the economic activity was somewhat slow. Q4 of last year, we saw a healthy pickup in demand, and the first quarter of this year, we're seeing continued recovery in the demand. As you'll know, over the last 3 years, commercial vehicles have had a down cycle, which got exacerbated by the COVID pandemic. But the last couple of quarters are quite healthy. We are seeing a pickup in 3 different segments. The first is in the tipper segment, largely driven by recovery in the mining coal sectors, as well as the infrastructure spend, which is quite robust for the next few years. Second, there is a good recovery in bus demand across various subsegments, staff bus, route bus, school buses, which for the last couple of years have been virtually non-existent, and now replacement demand is coming back. And lastly, in the haulage segment, also we are seeing recovery as economic activity, transportation, supply chain logistics have opened up quite nicely over the last 2 or 3 quarters. And all the leading indicators there, whether it's diesel consumption, e-way bills, FASTag collections, and so forth, are good indication of economic activity. And that is borne out by the commercial vehicle demand that we are seeing, which is coming back very nicely.
Expecting the demand to stay strong as well. Now, if you were to see the earnings report card that you came out with, we saw more than 100% rise in net profit. But then, you were also enjoying the benefits of the disinvestments made in Clayton and, of course, TVS Capital as well. So first up, has all of that been utilized or can the street expect, more one-time gain from that perspective?
Again, I just want to make sure I heard the numbers right. We've reported a 12% increase in our profits year on year, which is quite good. 24% top line disbursements growth on a like-to-like basis. But most importantly, our asset quality has pulled back quite nicely. Capital adequacy is at an all-time high, close to 25%. We are very well positioned on the capital adequacy front. And liquidity remains quite strong. So I feel in terms of all the fundamentals, asset quality, capital adequacy, liquidity, we are well positioned to look at the growth that we are seeing in the economic landscape, and one we hope to capitalize on and extend our market share in all the geographies and asset classes that we operate in.
Just shift gears and talk about something which the companies normally declare. Has there been a change in the shareholding pattern where Brightstar has increased their stake? Because that's the speculation in the market. Since it's the quarter is over, we can talk about it.
Sorry, can you repeat who you're seeing increase share?
Brightstar, which is owned by Mr. RK Damani.
I mean, the Damanis have been long-standing investors of ours, and likewise, we have a set of long-standing investors who see investment for the long term as a philosophy. Works very well for us. As far as we are concerned, I think promoter holding remains where it has been for a while now, as has been the public shareholding. I think the institutional shareholding moves a little bit up and down. But to the best of my knowledge, we're not seeing any significant shifts that are worth noting from a shareholding pattern standpoint. We remain committed to playing for the long haul. As we've said multiple times, we are marathon runners and not sprinters. We like to set a steady pace, get the growth, quality, and profitability trinity that has worked very well for us to be balanced for the long haul in mind. And inevitably, folks that have a longer-term perspective tend to like the way we operate.
I must say that I have the fantastic regard for Sundaram Finance. I have the pleasure of tracking this company for many years now. I've always admired the way the company has navigated the risk. But my question is that, aren't you getting too cautious? While one idea is that keep your capital adequacy intact, keep the balance sheet liquid, keep the NBAs under control. Great news. But when growth is coming back, and if you remain cautious, you will not be able to participate. The AUM growth on a year basis is just 4%.
Yeah, no, I think that's a very fair question. Through the pandemic and even prior to that, as the commercial vehicle down cycle started, the view we took was very much to do two things, right? One, be with our customers and support them with the hit that they have taken in their health, economic wherewithal, and so forth. And we fully were focused on taking all the dispensations made available by the regulator as well as the government in supporting that small road transport operator, the small entrepreneur, the small farmer, the small construction equipment operator, who were really deeply impacted by the pandemic. And so in the growth with quality and profitability trinity, we sort of privileged quality and profitability, and growth took a little bit of a backseat, and that we felt was the appropriate focus to take. If you look at this past year that has gone by, we've actually brought growth back. As I mentioned, 24% growth year on year in disbursements on a like-to-like basis. At the same time, we've pulled back quality to nearly pre-COVID levels, and we've declared a pretty healthy 12% growth in profits. So we think we've calibrated the balance between the three quite well. And in particular, if you look at our performance in Q4 of this past year, on a year-on-year basis, there's been a 16% growth. Profits have grown 49% actually, partly driven by asset mix improvement, but partly driven by sort of release of provisions due to improved asset quality. And the AUM point, which we made in Q4, we've actually grown AUM quite substantially compared to Q4 of last year. So our sense is we have exited the year with good tailwind and momentum. And if you look at Q1 of this year, we're off to a good start as well, building on that tailwind and momentum. And our sense is as the economic activity picks up, asset quality comes under control, we will get to our rightful market share and extend our share across all asset classes we operate, as well as all the geographies we're present in. So we remain quite optimistic about getting growth back and getting to the share that we expect to command in the marketplace.
Right. Rajiv, I'm curious to know, given the intense competition there is in the home finance business, what's the visibility that you have?
The home finance business has also been on a transformation path after fairly painful external changes and a relatively slow environment. We have now a new management team in place. The new managing director, the top team is all new. And they are bringing a fresh look at how to grow that business now. This past year has been a great validation of their strategy, the first year of the new strategy that they've put in place, focusing very much on the southern markets, tier 3, tier 4, rural geographies, getting a right balance between home finance, builder finance, and loans against property. So they've got that asset mix and diversification well as well. There have been some legacy asset quality issues which are also being addressed in a very focused and clinical manner. This past year, that subsidiary of ours has declared a 84% growth in disbursements. The challenge very much has been over the past year, I would say, the relatively low cost of borrowing, which was due to the pandemic accommodation that we saw. And somewhat, as you rightly mentioned, cutthroat competition on rates. We were seeing home loan rates at 6.25 and so forth, which was then resulting in a bunch of balance transfers. So although they sort of got their disbursements game together, the balance transfer threat always remains. Our sense is as we revert to some semblance of sanity, if you will, on both the interest rate, but also on the liquidity front, some of those cutthroat rates that were being offered will sunset relatively quickly. And there will be a reversion to sort of pre-pandemic levels of competition. And given the geographic and customer segment focus we have, we think we are well positioned to build on the foundation that has been laid over the past year by the management team. So we remain quite optimistic about the journey ahead on the home finance front.
Great. Good luck with that, Rajiv. Good to have you on the show, and we should chat more often about your future plans.
Look forward to it. Thanks for having us.
Okay, bye. That's the
Bye.
word. That's